Hi, good morning, everybody. Just to take you through an update on SA Equities and the Net Group SA Equity Fund, and really where we're seeing opportunities amidst the storm. So just a reminder, the fund is only invested in SA-listed equities. It doesn't invest in directly offshore listed equities, so it's a good building block. And the fund aims to be fully invested, so maximum 5% cash, and that's really just for trading and liquidity purposes, so fully invested. Just to recap on the performance of the fund, we've had a good year thus far. The fund is down about 1.1% year to date to the end of September, and that compares to the market, which is down about 7%, so about 6% of alpha, and that's sort of stretched across the periods from 1 year, 3 year, and since inception, which goes back to 2014 when we started the fund, and you can see that the alpha of about 1.5, 1.6% since inception annualized. A number that we like to look at, which highlights the consistency of the performance of the fund, is the hit rates of the fund. So what we look at, and that's the bottom table. If you look at the bottom 2 rows in that table, over rolling 3-year periods and rolling 5-year periods, how's the fund performed relative to the peer group, which is SA equity funds, as well as the market. And you can see in the bottom row, over rolling 5-year periods, we've outperformed the market by 80% of the time. Which gives an indication of the consistency of outperformance of the fund. This chart just highlights the performance of the fund over time relative to the peer group and the benchmark, and you can see how that gap is widened over time with the alpha generation. If I just look at some of the contributors and detractors from performance year to date, you can see that going into the year we didn't own any MTN. We sold out of our MTN position completely, and there we benefited from our Africa research, where we on the ground our sources were telling us that even though Nigeria benefits from a higher oil price, there is immense pressure because they export raw crude and they import refined product, and with the refining margins picking up and the local fuel subsidy, the local currency was under immense pressure, as well as the fiscal position in Nigeria. And Nigeria makes up about 40% of the valuation of MTN. And we also felt that the valuation got a bit carried away, north of 160 Rand, pricing in the fintech mobile money opportunity. So we sold out of our MTN position completely, and that contributed quite nicely. We also had a substantial position in Mediclinic, so we were very pleased with the offer from Remgrow. That added quite nicely to performance. We also had quite a lot of banks, which we still own in the fund. We still think that they offer good value, likes of Absa, Standard Bank, and we can see that they're very well provided going into the cycle. And then also British American Tobacco has been a core holding in the fund, and in this environment with inflation and uncertainty, they've got good pricing power, as well as offering stable earnings and a good dividend yield in this environment. We also had quite a bit of exposure to resources, particularly the energy complex via Sasol, and that's performed quite well. Of course, we won't get everything right, so on the right side you can see some of the detractors, the likes of Naspers in process has been, of course, a disappointing detractor this year. And that's largely due to the geopolitical concerns, the macro concerns out of China, and you can see Tencent and Chinese tech stocks have come off quite a lot, aggressive selling there. So we're not immune to that, and we've had quite a big position in Naspers in process, which we've taken pain on. We continue to hold on to that position. We still think that there's a lot that can be done to unlock value from the discount side, as well as Tencent, which we think is very oversold and very undervalued. And then Aspen has been disappointing, Anglo Gold as well, detracted from performance. So if we just look at broadly what the outlook looks like from here, so we know that there's heightened geopolitical tension at the moment, which with Russia, and then you've got China on the other side, and potentially what happens with Taiwan and what other things escalate from here. So we think a lot of that is priced in. The impact of Chinese lockdowns and on domestic growth for a share like Tencent and Naspers, and then as well as we benefited largely from the commodity cycle, and to what extent does China rebound and continue to consume commodities, it would have an impact on us. And then, of course, we've got the inflationary environment with monetary policy tightening. So if we look at all of that, and what that means for a recession and how deep a recession will be. So we have seen substantial deratings in markets, but we question the E, because the E is uncertain depending on how deep a recession will be. So from our side, clearly, the impact of a global recession and demand for commodities on the South African economy, we've got that as an overhang. And then we also got the upcoming ANC elective conference in the next month or two, which might create a bit of uncertainty in the short term. And of course, we all know that Eskom and increased load shedding, as the companies report results, you can see that they keep mentioning the heightened cost, the lost productivity or hours of production, as well as the cost of operating with load shedding. So we know we've got that quite a negative backdrop, but how much of this is actually priced in? So we actually see a lot of opportunity after the derating. You can see that this chart just highlights global markets and valuations. The dark green line, if you look at the right side at the bottom, is the South African MSCI index, and you can see that South African equities trading very attractively relative to emerging markets, global markets, the US as well. Most markets have derated, but South Africa, we started on a lower base and we've derated as well, so offering a lot of value. If you look at this chart, it's a custom index that we made. It's basically SA Inc. companies, so we strip out all the non-resource RAN hedges and the resources companies, and we look at, if we build a basket of just the SA companies, mainly your banks, retailers, SA industrials, what does that look like? And you can see trading more than one standard deviation cheap relative to history. We think offering a lot of value. And then the interesting thing is the other side of our market with our dual listeds or our non-resource RAN hedges, also trading very cheap. So clearly, markets have pulled back. So if you look at many stocks or markets, this is what the picture looks like. But I think the difference with our local market, as well as some of our locally listed offshore stocks, is that we've seen, some of them have already gone through a series of earnings downgrades. So when we question the E on some of these markets, I think we've got a bit more certainty on, especially the likes of a British American Tobacco, where the earnings, the E is less. We've got more conviction around that E. So we think that valuation is incredibly attractive, and we've built the portfolio, taking advantage of both sides of that equation. So with that backdrop, how we position the portfolio, we're seeing value on both fronts. On the global consumer side, we continue to hold on to Naspers and Prosus. British American Tobacco, we also added to Anheuser-Busch. We saw results out this morning, quite positive. And then on the SA Inc. side, we're seeing lots of value on SA financials, especially the insurers have come off a lot. They're trading at incredibly depressed valuations. We think that there's a lot of value there, especially Sanlam, Momentum as well. And then selectively on some of the other SA Inc. stocks, where we think that despite the constrained macro environment, these companies are well run, good management teams. They can actually benefit from market share gains or self-help stories where there's cost-cutting initiatives which can still drive earnings growth. So the likes of Woolworths and Pick and Pay, we also own some of those in the fund. And then on the resources side, we still have a preference for the energy complex. We think broadly, supply and demand is still quite tight given supply dislocations with what's happened with Russia. And we think that as economies are not fully reopened, all the planes are not in the air yet. So we think energy, despite recessionary fears, remains well supported, and we continue to hold Sasol and Glencore for exposure there. This just gives you a snapshot from a bottom-up perspective what the fund looks like in terms of currency exposure, and you can see about a third of the fund is directly exposed to rand earnings, and the rest comes from about 15% to EMXSA, which is largely Tencent, and then the other side from resources and offshore stocks. Overall, the fund, about a quarter of the fund is in global consumer stocks, and then banks making up another 15% of the fund. And I think we think we've positioned the fund well to benefit conservatively in a tough environment, as well as benefit from companies that should weather the storm quite well and into a rebound as well. That's a snapshot of the fund, and we'll stop there and we'll go into the panel discussion.